Hey, welcome back, options traders, and especially to all of our new traders. It's great having you here. And here is another good question for our trading group. What is row 2? And I thought this would be a good topic now because it's early 2022 right now. And at the end of last year, the Fed announced that it's probably going to start raising rates 4, maybe 5 times this year. And some traders have been asking questions, well, how is that going to affect option prices? And you probably know that's one of our Greeks about row. Well, if you're talking about interest rates and to really understand the effects, we should also understand row 2. So a second reason I thought this would be a good topic is that, as I've mentioned in many previous videos, that there are actually a lot of different Greeks. We all know the kind of the main ones, the key Greeks, but there's a lot of different ones. And this is one that most people are unfamiliar with, and it sometimes goes by the name of row 2. So what is it? And how will it affect your options prices? Well, as a basic refresher, the Greeks, at least your basic Greeks, the ones that everybody should know, are delta, gamma, theta, vega, and rho. And in this video, we're going to add another one that is called row 2. And some of the more technical books, more of the academic books, will probably refer to this as epsilon. So if you see row 2 or epsilon, it's the same thing. So in a sense, row 2 is a way of dividing up row. And in a similar way, think about it like your option premium. The total price that you pay for an option, we can divide it up into intrinsic value and extrinsic value, but we can also divide the extrinsic value. Most people don't think of it this way, but we can divide the extrinsic value into volatility and cost of carry, which is the interest rate portion. Well, in a similar way, we could break that cost of carry down into row and row 2. So when it comes to row, our effective interest rates, we have row 1, which again looks at the interest rate. What is the risk-free interest rate, and how does that affect our option prices if there is, let's say, a 1-tick change in interest rate? So the interest rate rises from 2 to 3%. What's that going to do to your calls and puts? And that's what row shows us. Now, row 2, on the other hand, is really the effect of dividends. Now, sometimes people say, well, wait a minute, dividends aren't really interest rates. Why would we lump them in kind of the same category here? Well, it helps, instead of thinking of row as interest rates, think of it more about carrying costs. And that's going to be affected by interest rates and dividends. And so that's why we have this distinction between row 1 and row 2. So what are these relationships? Well, the interest rate and dividends have opposite effects. Increasing interest rates increases your call prices, and increasing dividends will decrease your call prices. So do you see how they have opposite effects? Now, of course, you will get the opposite effects for the puts. If your interest rate rises, it's going to drop your put prices. And if your dividends increase, it's going to increase your put prices. Now, if you have a steady stream of dividends paid throughout the year, such as with the SPX or in the SPY ETF, we can call those continuous dividends. It's not like all the dividends were paid in January. They're not all paid in December. They're not all paid in the middle of the year. They're sprinkled about equally throughout the year. And if that's true, we can just use a simpler formula of interest minus dividends, and that would give us an effective interest rate. So instead of saying that, let's say, interest rates are 3% and dividends are 1%, we could just say that effectively the interest rate is 2%. And you could go into a pricing model and just call it interest rates are 2%, and that would give you about the same answer as if you did interest rates of 3% and dividends of 1%. So you can see from this formula, interest minus dividends, the effects. If you increase interest and you increase dividends, it's increasing the call price, but this is decreasing the call price. You have to subtract that out. And again, of course, you'll get the opposite effect for puts. So just always remember interest minus dividends, and that will give you sometimes what we call an effective interest rate, and that will help you to understand the relationships. So to see it in action, let's go back over to our OIC pricing calculator and look at some examples. All right, so here we are back into the OIC's pricing calculator. And the first thing I'm going to do is to change this from American to European style. And the reason that I do that in a lot of these examples is we're trying to block the effect of any benefit that the put holder might have by exercising early. So that's not what we're trying to analyze, so let's just get rid of it. And the way we do that is to choose European. Let's use a stock price of 100, strike of 100, 360 days or 1 year. I'm doing that just to make the math easier. 20% volatility, and I'm going to start with 4% interest rates. We choose calculate. We get a call price of about 983 and a put price of 598. If I increase the interest rate 1 tick or 1 percentage point, in other words, from 4 to 5, then we will increase the call price by some amount and we will decrease the put price by some amount. And this is exactly what row shows us. So how much will that call option increase? About 51 cents. It's a positive number. It tells us that if interest rates rise, the call is going to rise. What about the put? If interest rates rise, the put's going to fall about 43, maybe 44 cents. That's what the minus sign is. So let's try it and see. Let's go from 4 to 5. And there we go. About 1033 and 557, exactly what row predicted. Now, what if we increase the dividend? Let's go from 0 to 1. We should see the call price decrease and the put price increase. Now, they're not going to be $1 each, and they're certainly not going to be 50-50. There's a little bit of math involved. It's going to get shared between them. But let's click on calculate and see the effect of the dividends. So there you can see that the call price did fall from 1033 down to 971, and the put went from about 554, 555 or so to 594. Okay, let's go back and make this dividend 0. Let's go back to our 1033 and 557 prices. To see these relationships a little bit easier, sometimes it also helps to block the effect of volatility. So let's put volatility down to something really low, let's say 1%. And what you're going to see is that this call price still has a value. This is the bare bones minimum for the call under these conditions. This is one of our option pricing boundaries. The call would have to trade for at least $4.76. Otherwise, there's an arbitrage opportunity. So where is this number coming from? Well, think about this. If you have a 5% interest rate, let's say that you deposit $100 at a bank, you would have $5 of interest at the end of the year. Well, we're not trying to figure out the value of that interest in 1 year, such as we're doing right here. We're trying to figure out what it's worth today. And to do that, we have to take what's called the present value. I need to take this $5 of interest divided by 1.05, or 1 plus the interest rate. So let's take 5 divided by 1.05, and we get 476. That's where that number is coming from. So now watch what happens if I increase the dividend $1. This is going to drop by $1. We're going to go from 476 to 377. Now you might think, hey, it's not exactly $1, and gets a little bit more technical here about when the interest is compounded and when the dividend is paid. But for all practical purposes, it decreased it by $1. Now here's one of the main things I want you to see. Notice this combination of 5 and 1. 5% interest rates and 1% dividends. Okay, so 1% dividend is a $1 dividend on a $100 stock over the course of a year. So in the presentation, we talked about interest minus dividends. So if we get a price of 377 with a 5-1 combination, I should be able to get about that same price with a 4-0 combination. Let's try it. Let's do 4 and 0. And we're going to go from 377 to 384. So we're off by about 7 cents. Once again, the reason that we're off a little bit has to do with the compounding of the interest and when the dividend is paid. But for all practical purposes, we can just look at this as a 4% interest rate. So hopefully that helps you to see the relationships. Interest rates minus dividends give you an effective interest rate. Again, that's assuming we have continuously paid dividends. But these are important relationships when you are stress testing your strategies, which is always a good idea. What if the interest rates go up? What if dividends go up? What if they go down? What's that going to do to your strategy? And if you have a better handle on these possibilities, you're going to have fewer unwanted surprises. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.